All right, let's do an example. Let's evaluate a potential purchase of Walmart stock using the CAPM model. Okay, so let's go back in time a little bit, but not much. Let's say we're a hedge fund manager in 2018, and our investment mission for our hedge fund is we make 1 year purchases of low volatility stocks that have, in our humble opinion, IOHO stands for in our humble opinion, a high probability of being positive NPV investments. Okay, so that's a fine mission statement. Nothing wrong with that, and let's go from there. So, given that mission statement, the hedge fund is considering buying shares of stock of Walmart here. Okay, and they've got a graph of the price of the SPY ETF that follows the S&P 500 in dark blue, and a graph of the price of Walmart in light blue. And just looking at this without having to do 30 years worth of returns and getting standard deviations or values at risk or anything like that, you can clearly see that Walmart is much less volatile than the S&P 500. And if you were at all concerned about that, you could go ahead and compare standard deviations of returns or value at risk or something like that, and that would confirm this. Okay, so clearly Walmart does fit our investing mission, right? It's a big stock. It's probably, I'm sure, actually it is in the S&P 500, so it's just fitting our investment mission very nicely. So now, given that, the our managing director wants us to find, first of all, what's the cost of capital we should use in analyzing our potential purchase of Walmart. Use the CAPM model, okay? And then secondly, let's find out, once we've got that in our pocket, what if we buy $1 million worth of shares today and we estimate we're going to get 25,000 in dividends in 6 months and again in a year, and we estimate that Walmart's stock price will appreciate by 10% over a year, and then we sell the stock, that fits our mission. Is this a positive NPV project for the hedge fund? So let's see if we can figure all of this out. So let's do A first. Okay, we want to determine our equity cost of capital using the CAPM model. So really, we just need to get all our inputs here and then multiply them and add them together, and we're done. Okay, so as usual, RF is our risk-free rate. So all we do is we go out to Bloomberg, okay? We go out to Bloomberg and we find the average promised interest rate of Treasury bonds with a year to maturity. We can take promise because we feel the probability of Treasury bonds not being paid off is so low, it's negligible. So we just go out to Bloomberg.com, we look that up, and we find 3%. And we have, of course, some key assumptions here that, of course, the future is going to look like the past, et cetera, et cetera. And now I'm going to go with, instead of taking 30 years to get the average RM, I'm going to just use the stock market risk premium, which is RM minus RF. Okay, so the nice thing about that, because as you know, I'm very lazy, is instead of doing 30 years worth of returns and getting the average and maybe making a mistake and all that stuff, I can just steal what some very smart people have to say about this. So just because it's my alma mater and whatever, I'm going to choose out of all these possibilities, I'm going to say that the Columbia Business School's estimate is best. That's probably, just speaking off the record here, parenthetically, that's probably pretty stupid because it's the highest of all of these. So a smarter thing to do might be to take the average of all of these, but whatever, okay? I have chosen, I'm doing this lecture. When you do the lecture, you can do something better. But I have chosen the Columbia Business School's 5%. So I'm saying that the market risk premium over the risk-free rate is 5%. So now I've got pretty much everything I need. All I need is beta. So let's go see if we can get beta for this. Remember, beta is going to come from our linear regression, or also if we wanted to instead compute correlation coefficients between Walmart and the S&P 500 and get standard deviations, we could use that. But probably the best, most direct way to get beta is to just do a linear regression of the returns of Walmart versus the market for the past 30 years. And so we're going to say for the market, we'll choose to represent the market, the SPY ETF, as we have been doing. The reason why is it tracks the returns of the S&P 500 very closely. Walmart is a large cap stock. These are large cap stocks, so this is a good representation of the market. And I'm choosing SPY instead of the index itself because we can actually invest in SPY, right? So if Walmart doesn't look good and we're sitting on $1 million of clients' money, maybe we throw that into the SPY instead. Okay, so our key assumptions for assuming computing our beta with our historical returns are, again, if we're using historical returns to compute this number, we are assuming the future will look like the past, so the future beta is going to look like the historical beta. And also, we're getting this from linear regression, and it better have a high R squared value. R squared equals X percent says X percent of WMT returns are explained by SPY returns. Okay, so that's going to be important for us. Okay, so I went through and I did the regression for us, and I don't remember exactly why, but I just used 24 years instead of 30 years. I'm sure I had a good reason for that at the time, but I honestly can't recall it. 30 years would have been better. So here's a list of the returns that I had for Walmart and SPY. So first year, second year, Walmart 4.44%, SPY 22.15, et cetera, et cetera, et cetera. So I got the average was 6% for Walmart, almost 14% for SPY. Walmart clearly, here we go, here's our much lower standard deviation, so it's definitely not nearly as volatile as SPY. And I got our correlation coefficient of 73%. And then from the linear regression, which I plotted for us over here, I got the beta. So the slope is very low, right? Here, if it were 0.5, that would be a 45-degree slope. So very low slope. And the R squared, which also pops out of the regression when you do that in Excel, was 53%. So here's what the data looks like when we plot it. Each blue dot here represents on the y-axis what the return of Walmart was given what the return for the SPY was on the x-axis. So you can see there's a lot of spread here, but there's also it looks like you could reasonably maybe draw a line through this, and that's what the linear regression went ahead and did, and it gave us this line, which is represented by the sort of pumpkin orange dots there. So when the S&P is returning nothing, Walmart is expected on average to be returning 2.2%, and that's our alpha down here. And the beta is the slope, clearly much less than 45 degrees here. And the R squared of 53%. Okay, so let's put in warning. Okay, R squared says that only about 50% of WMT return behavior is predicted by the behavior of the SPY returns. So that's maybe not so good. It would be nice to have something higher than that. But now we have all the inputs that we need, so that's great. Okay, so we have our RRF was 3.0%, plus I took that 5.0%, which is probably dodgy, but nonetheless, that's what I chose. And our beta, I don't remember, it was 0.2 something, 0.273. Okay, so times 0.273. Okay, and if you work that out, you should confirm this, that you get 4.37%. Okay, so what is that? That's the estimated equity cost of capital for Walmart, and it's what we want to use for discounting. So it's what we want to use for discounting with our NPV method for Walmart stock. And remember, I gave you that warning on the prior page here that the R squared is 53%. That's kind of low. Okay, and as always here, everything we've done going into this model is assuming the future looks like the past, which is very often, as we know, a bogus assumption. Okay, so that's part A. So we were able to estimate the equity cost of capital. And now for part B. So we didn't want to do that all for nothing, right? We're working in this hedge fund. We're thinking about buying stocks for our customers, right? So we want to know, based on additional assumptions here about Walmart, if this looks like a positive NPV project for us. So what would be the project? So we buy $1 million worth of shares. Our best estimate, and this is just our boss's estimate that was given to us, is that we'd get 25,000 of dividends in 6 months, and again in a year. And also, our boss estimates that Walmart's stock price will appreciate by about 10% in a year. And we're going to sell at the end of a year, so we'd get our 1.1 times 1,000 back there. And we want to know, is this a positive NPV project? So as always with things like this, it's good to draw a cash flow diagram. So here's when we buy all the shares, we get the dividend, and we sell the shares. And this all happens over the course of 1 year. So how are we going to do this here? We just use our NPV formula. And here, our opportunity cost of capital, the CAPM model says to us, when you use the CAPM model, what do you use for opportunity cost of capital? You use RE. So that's what we need to do here. Okay, so our NPV is, let me just go back because again of the early onset Alzheimer's problem that I have here. I think I got all my cash flows now lined up, 1,000, 25, 25, and 1.1 times 1,000. So our NPV is going to be minus 1,000 and then plus 25 over 1 plus 4.37%. And what's that raised to? That's in 6 months, and I'm measuring things in years. So that's going to be 0.5. And then plus, and so this is going to be 25. We get that second dividend plus 1.1 times 1,000. That gives us our appreciation, our expected appreciation of the amount of money we put in to buy shares there of 10%. And this gets discounted by a year, 1 plus 4.37%. And this needs to be raised to the 1. And let's bring this into Excel and see what we got here. Okay, and we got 102 2.367, and that is greater than 0 in most circles, so that's good. So based on all of our views and assumptions, and you see how many we've had to make to do this, we should buy the shares of WMT. Okay, so for us, we think that this would be a good project, and we get back to our general manager with that, and that's it. Okay, and the rest of this chapter is an appendix about refining the CAPM model. Remember, we did look at some folks use refined versions, modified versions of the CAPM model. If you're super interested in that, you can read all about it in this appendix. And for everyone else, thank you again, as always, and I'll look forward to catching up with you again soon.